The U.S. Treasury market is huge. It's grown 6 times larger since 2008. This growth raises concerns. Can the global market handle so much U.S. debt? It's a question worth asking. Many experts are watching closely. The 2008 financial crisis changed things. The U.S. government took on more debt. They bailed out banks and stimulated the economy. This led to a surge in Treasury bonds. These bonds are seen as safe investments. Investors around the world buy them. The U.S. dollar is the world's reserve currency. This means it's used for international trade. It also means there's a high demand for U.S. dollars. This demand supports the Treasury bond market. Foreign countries need dollars. They buy Treasury bonds as a way to hold dollars. But the large size of the market does create risks. If investors lose confidence, it could be a problem. A sudden sell-off of Treasury bonds would hurt. It would drive up interest rates. This would make it harder for the U.S. government to borrow money. It would also slow down the economy. A historical perspective. The question of whether the world can absorb U.S. debt isn't new. In the 1980s, the U.S. faced a similar situation. Paul Volcker, then Federal Reserve Chairman, took drastic measures. He raised interest rates sharply. This was to combat high inflation. Volcker's actions worked, inflation came down, but they also led to a recession. This period highlights the delicate balance. Managing debt, inflation, and economic growth is tricky. It requires careful policy decisions. Today, the U.S. is not facing the same level of inflation as in the 1980s. But there are other concerns. The COVID-19 pandemic and the war in Ukraine have created uncertainty. Global growth is slowing. This makes the question of debt sustainability even more important. Some argue that the U.S. can sustain high levels of debt. They point to the dollar's status as the reserve currency. Others are more cautious. They warn that high debt levels could lead to inflation. They argue that the U.S. needs to get its fiscal house in order. The real issue isn't the quantity of U.S. debt, it's inflation. When inflation is high, the value of debt decreases. This might seem good for a debtor, but it creates broader economic problems. It erodes purchasing power. It makes it harder for businesses to plan. High inflation in the 1970s and early 1980s forced a response. Paul Volcker's actions proved this. The focus shifted from debt to inflation. This is a lesson for today. Fiscal policy, not just monetary policy, is crucial. The U.S. government needs to be smart about spending. Uncontrolled spending fuels inflation. This is where fiscal policy comes in. It's about government spending and taxes. Getting this balance right is key to controlling inflation. Some economists argue that the U.S. has more room to borrow. They say the current debt levels are manageable. But this view is not universally shared. Others warn of the risks of complacency. They argue for fiscal restraint. They say this is the best way to ensure long-term economic stability. The U.S. dollar reigns supreme. It's the global reserve currency. This gives the U.S. a unique advantage. It can borrow at lower rates. Demand for dollars remains high. But this privileged position isn't guaranteed. Fiscal irresponsibility could undermine the dollar. If investors lose faith, the dollar could weaken. This would have global repercussions. It would make U.S. debt more expensive. It could lead to a loss of confidence in the U.S. economy. Jay Powell, the current Federal Reserve Chair, is aware of these risks. He has hinted at the need for fiscal discipline. He's been careful not to overstep his role. The Fed's primary focus is inflation, but Powell understands the link between fiscal and monetary policy. The U.S. needs a sustainable fiscal path. This means addressing the growing national debt. It means making responsible spending choices. It also means ensuring that revenue can cover expenses. Ignoring this issue is dangerous. It risks the dollar's dominance and it threatens the stability of the global economy.